Good afternoon, everyone. This is Chris Burgoyne from the American Hotel and Lodging Association. We're going to be getting started in just one moment. Thank you for joining us today. Hello, folks. This is Chris Burgoyne from AHLA again. We're going to give it one more moment as it looks like folks are still joining us. So thank you for your patience. Okay, folks, we're going to get started here. Again, my name is Chris Burgoyne. I'm Vice President of Government and Political Affairs at the American Hotel and Lodging Association. We're thrilled to have Alex Passantino from Sayforth joining us today as our guest presenter about the new overtime regulations that were finalized on September 4th by the Department of Labor. AHLA has been engaged on this overtime issue for a number of years. The last time that the overtime rules were updated were 2004. So certainly a lot of work has gone into this, and the implementation date, as you all know, which is why you're on this, is January 1st, 2020. So we're glad that you can join us. We're thrilled to have Alex here, and he's going to provide you a lot of these details about the overtime plan to ensure that you and your associates are covered and are up to speed. As you all know, hotels are an industry of people, taking care of people. Our associates are our most valuable asset, and as such, AHLA has long advocated for policies to modernize our nation's labor laws to benefit both our associates and business owners. AHLA believes that the new overtime rule accomplishes just that. Updating outdated salary levels make more employees eligible for overtime while providing much needed clarity and certainty moving forward for AHLA members. Alex is going to get into the details of this plan, and we're glad to have him here. Alex focuses his practice on all aspects of wage and hour law. He brings a unique knowledge and experience as a former acting administrator of the U.S. Department of Labor and U.S. Department of Labor's Wage and Hour Division. Alex provides day-to-day advice to assist employers in how to comply with the Fair Labor Standards Act, the FLSA, and state laws that require employers to pay overtime and minimum wage to their employees. In addition, Alex provides guidance and counsel to government contractors who are subject to Service Contract Act and Davis-Bacon Act. He advises clients on implementing compliance programs, auditing and correcting wage and hour issues in response to the ever-changing wage and hour legal compliance. Alex has also defended numerous wage and hour lawsuits, including both individual claims and class and collective action bargains. So we're thrilled to have Alex here. As I mentioned before, AHLA has been engaged with this process for a number of years now. Alex has provided counsel to AHLA on this, and earlier this year we filed comments on behalf of the industry after extensive outreach to members, member surveys, and feedback through our various committees. So thank you to all of you that have been a part of this process. We thank you for joining us today, and without further ado, I will hand it off to Alex to give you an update on the specifics of this overtime rule. Alex?
Thanks, Chris. This salary increase is, as many of you know, the culmination of a long history of regulatory activity. So I think it's actually important to go back to 2004, which is the last time that these salary levels were updated, because that was the last time they were updated in 30 years. It was 30 years preceding 2004 to get an update. And then in 2014, President Obama directed the Department of Labor to engage in the rulemaking process, to take a look at increasing the salary level. There was a proposed rule that went out at $50,000 a year. That proposed rule ultimately was finalized at $47,476. In 2016, later in 2016, some folks sued and were able to get that salary level from enjoined from going into effect. In 2017, a new president was sworn in, and the Department of Labor changed its position on what it was going to do with that salary level. Throughout 2017 and 2018, the department did a request for information, had a bunch of listening sessions. I mean, there has been so much work that has gone into coming up with this salary level that it's hard for me to believe that we're actually here in 2019 talking about what I hope is the final chapter of this saga. We haven't heard of any lawsuits getting ready to be filed. We're getting pretty close to the time where they would need to do that in order to make a difference on the January 1st implementation date. So we should be going full steam ahead to see what the new salary level is and to make sure that we're doing everything we need to do to be in compliance on January 1. Sorry, I thought trying to advance the slides here. Okay, so the new level is $35,568 a year. It's really $684 a week. That number is up slightly from the proposed rule that came out earlier this year. The proposal was $679. What I, as a wage and hour geek, find funny about it is when it came out at $679, I commented that it was almost exactly the midway point between $23,660, which is the current level, and $47,476, which was the Obama administration level. They went ahead and they changed it by $5 a week, and that $5 a week made it the exact midway point. So $35,568 is the exact midway point between the current rule at $23,660 and what it would have been had the Obama rule gone into effect. So I'm not saying that they split the difference, but they split the difference. They came right down the middle, came out with a salary level that I think they could live with, that they think the court system will uphold, and they didn't go too high, they didn't go too low. They really did try to come in with a level that made everybody not completely happy and not completely unhappy. That $35,568 is the 20th percentile of full-time salaried workers in the South and or in the retail sector on a national basis. The rule goes through a long description and a long analysis of why that's the right level in an effort, I think, to preserve that methodology for future levels. So there's no guarantee that when this gets revisited in the future, they'll use that same methodology, but that was the goal of the rule. But we're sitting there looking at $35,568, $684 a week. That new salary level, which will go into effect on January 1st, also brought with it a provision from the final rule in 2016, which will allow employers to use bonuses, incentive pay, commissions to satisfy up to 10% of the salary. As long as on an annual basis, which is a change from the old rule. It used to be a quarterly basis, but they've now finalized the rule on an annual basis. As long as you are paying the bonus annually, you are able to satisfy the salary test by paying 90% of the salary on a weekly basis or biweekly basis, and then as long as the bonus on an annual basis meets the difference, you would meet the salary test. So what that means is you could pay someone $615.60 a week over the course of a year, and as long as that person earned a bonus at year end, or commissions or whatever, some other type of incentive pay, of $3,556.80, you would meet the salary test for that year. So you could pay that lower number, $615.60, as long as there was a bonus at the end of the year that got them to $3,556. If you miss the $3,556, you have to make a catch-up payment. So it's basically a guaranteed bonus at the end of the year, but it does allow you to defer some of that compensation for year end for somebody who you only want to pay 90% of that salary level to. I don't think it really impacts us that much, but it's worth noting that room and board and a whole variety of other let's call them non-cash payments have continued to be excluded from determining whether someone's met the salary level. So right now we're looking at salary, $684, up 10% of that amount can be met with bonuses and commissions. You can do that on a weekly basis. You can meet it on a monthly basis. It has to be at least annually. One good development in the 2019 rule, so the current rule, is they rejected the automatic update. So in 2016, we had a rule that would have automatically updated the salary level every 3 years. In the proposed rule earlier this year, the department said, well, we're not going to do an automatic update, but we super duper secret pinky swear that we're going to do it all the time. We're going to do this more frequently. They've backed off even from that, and they just said, we're going to review the salary level more frequently. We're going to go through notice and comment rulemaking. And remember, that they're doing that against the backdrop of 2 proposed increases in 45 years. So more frequently than once every 22 and a half years, I think we could live with. I would suspect that we're looking at a 4 to 5 year process before they're going to take a look at it again. Of course, a new administration could come in and change it and pretty much go through the notice and comment rulemaking whenever it desired, and raise the salary level at that point. But this rule says, look, we're going to do it. We're going to do it more frequently than we have been. We recognize it's an issue, but we're not going to commit to any specific timetable.
Hey, Alex, it's Chris. Just to interrupt you for a second, I want to remind everybody on the call that there is a Q&A portion at the bottom of your screen. Alex is reviewing that and certainly can clarify anything that comes up along the way, and we'll answer questions directly at the end of it. But I just realized I forgot to do that at the beginning. Thank you.
Great. So there is a provision called the highly compensated employee provision. And that provision of the law says, look, you still have to perform exempt duties, right? You're not going to get out of performing exempt duties. But if you get paid right now, currently, $100,000 or more per year, we're going to have a lower threshold on those duties. And so instead of you having to meet the full executive exemption test where you supervise 2 or more and you have the power to hire or fire, and things like you manage a regularly and customarily recognized department or subdivision. So rather than having to meet each part of that, you just have to perform a job duty that meets one of those elements. That is an exempt job duty. You have to perform it, and you have to be paid at least $100,000 a year. That level was in the proposal earlier this year. It was proposed to jump from $100,000 to $147,000 per year, based in large part on the comments that the business community submitted. That amount actually is only going to increase to $107,432. So obviously that's way less than 147. It is a fairly minimal increase, really, from the $100,000 level that exists right now. And again, I think one of the key pieces is that the department went through and for the first time established a methodology on how they were going to compute this level. So they said, we're going to go and we're going to look at the 80th percentile of full-time salaried workers nationally. If somebody earns more than that, we're going to say that they can qualify for the highly compensated employee level, and they can be exempt with a reduced burden on the duties test. They still have to perform exempt duties. This doesn't get you out of looking at an employee's duties to determine whether they are exempt. It just makes it easier because of the amount of money that they're making. The amount of money is sort of presumed to get them to the exempt status level as long as they perform a threshold amount of exempt work without necessarily meeting the full-blown duties test. Importantly, the highly compensated level still requires the $684 per week salary. So they still have to earn a salary of $684, that $35,568 number, and then the delta between that salary and $107,432 can be made in commissions and non-discretionary bonuses or some end-of-year catch-up payment. There is no what I'll call bootstrapping, so you couldn't use both provisions related to bonuses and commissions. You couldn't pay somebody 90% and say, and we're going to get you to the 10% to get you to the salary level, so the provision we talked about just a minute ago, and then the remainder of that gets you to highly compensated. You actually do have to pay the $684 a week. But if you've got somebody who you're only paying $684 a week, that basically means you pay them $35,000 a year in salary, and they have a $72,000 a year bonus, and are performing exempt duties. So I think this is really for employees who are earning much closer to $107,000 than the minimum salary. It's theoretically possible to do it with the minimum salary. But if you wanted to ensure that you met the exemption, by year end, you would need to make sure they made that $107,432. And again, that is just, it's a supplement to the standard duties test. So you have the standard duties test, and then this is another provision that says, hey, you still have to meet some aspects of the duties test, and as long as the employee is paid a much higher rate of pay. There were no changes to the duties tests. So there, over the course of this process, going all the way back to 2014, the Department of Labor has contemplated making changes to the duties test, to the definition of primary duty, never proposed any specific language, never made any specific proposals, just asked a bunch of questions, said, do you think we should change it? How should we change it? What should we do? At the end of the day, in this final rule, the department does not make any changes to the duties test. So someone who is performing exempt duties, who qualifies as exempt today, would continue to qualify as exempt on January 1st, 2020, provided that their salary either currently exceeds the $35,000 level or is raised to exceed the $35,000 level. The duties test is exactly the same, no change in job functions whatsoever. The department also didn't make any changes to the salary basis test. The salary basis test is the rule that requires that not only does the person get at least $684 a week, but that $684 has to be paid on what's called a salary basis. That means you can't make deductions, you can't, it's payment on a weekly basis of the same amount week after week after week. There are 7 enumerated exceptions when you can make deductions, including full day absences. That those have been read to allow you to make deductions from things like sick leave banks and PTO banks in pretty much any increment. But the person's pay each week needs to be the same. No changes to that test. That test is exactly the same today as it was previously. there was a lot of effort in the rulemaking process to get exceptions or allowances or exemptions or whatever you want to call them for part-time employees or people who work for nonprofits or public entities. None of those changes went in. The only thing that this final rule does is changes the salary level required for exemption, changes the salary level required for the highly compensated, and allows up to 10% of the standard salary to be met with payments other than salary payments. I guess you had about 3 months to comply. You've got a little bit over a month at this point to comply. When it came out in September, early September, we had 3 months to get into compliance. Now we're on a much closer timetable. That effective date is January 1st, 2020. It is, as is always the case with these types of changes, kind of a pain in the neck because January 1st is a Wednesday. It's doubtful that your work week starts on a Wednesday, so you actually have to change the salary to include that week, that whole week, at the new salary level if you're going to make a change to someone's pay in order to meet the exemption. For biweekly pay, obviously, you'd need to make sure that the pay was adjusted for whatever pay period included January 1st, 2020. There is a question that I'll address now because it goes directly to that 90% test, the 10% tolerance level that you're given on the salary level. So the question is, what happens if you're paying somebody at that lower level, that $615 per week, and you're doing that banking on the fact that they're going to make a bonus at the end of the year that gets them over the threshold, and they leave the company before the end of the year? That is a good question. The issue is, if you need the exemption and you want that person to have been exempt for the period of time that they are employed by you during the course of that year, you're going to need to make a catch-up payment at the time of their termination that gets them to the 684 level. If you don't need the exemption, then you don't have to make the payment. But in order to maintain the exemption, you do have to make that payment to ensure that they hit the 684 level. I know that that is not it's not the greatest news in the world. It's kind of a pain in the neck, but that's the trade-off that allows you to pay the lower level. Otherwise, you could, I suppose, see scenarios where you just paid that 615 level for 7 months, 8 months, 9 months. Maybe you pressure somebody to leave, or you fire them, or whatever. When that person leaves employment, if they haven't gotten the 684 and they haven't gotten bonus payments that get them over the 684 from the 615, they're not exempt. The rule does not have a tolerance in there that would say, okay, you can just wash your hands and walk away from that scenario. We get questions all the time about part-time exempt employees. And as I noted on the previous slide, there is no specific carve-out for a part-time exempt employee. You don't get to prorate the salary level based on, this person's a 50% employee, so we're only going to give them 50% of the salary. That doesn't work for exempt status. So there are some circumstances, some positions where there's no salary test at all. So doctors, lawyers, teachers, outside sales don't have any salary requirement at all. For every other exempt status, the requirement is that you be paid that full salary level. It means that anybody who earns under that salary level is non-exempt. You got to track their hours, you got to figure out their regular rate of pay, you got to pay them overtime. Now, if you got somebody who's working a half-time schedule, I think the assumption is that they're not going to work overtime. The issue is that you actually have to pay attention to that. You can't just assume that they're not going to work overtime. You have to pay them the salary level that you're paying them. You can continue to pay them that salary, but in the chance that that person works more than 40 hours in any particular work week, that salary has to be paid for. You have to pay overtime for the hours worked over 40, and you do that by dividing the salary by the number of hours worked. There's a whole formula to do that we'll actually talk about in a minute in connection with converting employees to non-exempt status. But for a part-time employee, you don't just get to say they're earning more than 50% of what they would have earned, they're working a 50% schedule, and they're performing exempt duties. You do actually have to meet that salary level. There's a question about seasonal positions that are salaried during the season. Assuming that this is actually a seasonal position where someone comes in and takes on that exempt role and is paid a salary, as long as that person is paid $684 a week on a salary basis, that's all that's required. There is no requirement that somebody earn $35,568 per year. That is a shorthand way that we're all referring to the 684 requirement. So the requirement is actually 684 a week. If you have somebody that you bring in and you're going to keep them in an exempt role for 2 months, as long as you pay them 684 a week for those 2 months, they're going to meet the exemption if they meet the job duties. You don't need to worry about the fact that they're not going to get to 35,568 for the year. All right, so what happens next? We know what the rules are. We know that there are going to be decisions that we have to make. Hopefully we've already started having those conversations and have looked at this. Obviously, in some cases, there is a very easy solution, and that is if somebody is earning $34,000, it's pretty easy to say, okay, we're going to pay them $35,568. Now they're going to meet the exemption, and we're going to be able to maintain exempt status for this individual who we would have lost exempt status for had we not increased the salary. So for the folks, right now what we're talking about are the folks who are between $23,660 and $35,568. So the current exempt status salary level and the new exempt status level. Everyone in there, you have a choice, which is to increase their salary to over the new level, to higher than the new level, and then you can continue to treat them as exempt. You can say, well, we're not going to make that increase, and we're going to reclassify them to non-exempt status, and we'll talk about the different methods of transitioning and the different types of pay structures you might want to implement. You can also just take this as an opportunity to restructure positions, to change the way that your staffing model or your different management roles. Maybe you combine roles, and that justifies your ability to increase somebody's pay. Maybe it is you take some of the exempt obligations from a borderline position that allows you to justify a position that is exempt, but then you have a position that is more clearly non-exempt, and you staff that with somebody who is less experienced and who doesn't need to have the same qualifications as an exempt manager does. So you can use this as a chance to restructure that position. So what are you doing? You're doing what we call the gap analysis. That is the level for the positions that fall below the new standard. Obviously, when you're making these changes, particularly when you're talking about increasing somebody's pay, you have to consider the ripple effect. So does somebody's, if you increase a manager position, does that person's manager have to get an increase because now you've closed the gap between those two individuals' pay? So this is it's just a bigger analysis than a particular position. You've got to go ahead and look at the duty tests, and I think this is a good opportunity for us to look at positions that maybe we're not so confident should be exempt positions, and to use this as an opportunity to reclassify them to non-exempt positions. So again, you need to meet the salary test, you need to meet the duties test. In 2016, when it was a huge jump, it was a lot easier, I think, to justify transitioning positions from exempt status to non-exempt status. And I know a lot of employers at that time used that change, the change in the salary level, to justify just this is a position that we've had questions about for a long time, that we've had concerns about, maybe where there have been lawsuits in our area on that position over the past several years, and we're going to use this as a chance to reclassify that position. The gap isn't as big now, but it's still a good opportunity to do that. If there are positions where we have concerns about the duties that someone is performing and whether those duties actually meet the duties test, this is a good opportunity to take a look at that and decide we're going to use the Department of Labor's regulatory changes to our benefit and reclassify those positions. How do you determine whether to reclassify, or when you are reclassifying, how do you determine how to do it? Obviously, you need to figure out as best you can what hours this exempt employee is working. One of the things that we find when we're talking about exempt employees is we don't really have good records on how many hours somebody works in a day or a week. And so we need to recreate that somehow. Sometimes you can do that with things like badge swipes or computer logins, things like that. You also want to determine, okay, if we make this person non-exempt, how do we think that's going to change? Are there any similar positions we can look to understand how many hours somebody is going to work during the course of a work week? When you're looking at the records, are we missing things like this person emails after work from home? Are there times when somebody's not logged into a computer or not badge swiped, but they're still on the property and doing work? These are all the things that you need to think about as you're determining how we are going to go about reclassifying a position from exempt to non-exempt. You want to talk to managers, you want to talk to pretty much anyone you can to get that kind of information. What you then need to do is figure out how are we going to make this conversion? How are we going to change from an exempt salary where we pretty much know what somebody is going to earn every single week to hourly or some variation of hourly, non-exempt pay, where somebody works overtime, we're going to incur different expenses. And so you need to know what those hours are. There are a variety of ways that we can pay non-exempt employees. Obviously, the easiest way is to pay them hourly. You can, that an hourly pay means that you're just going to pay that straight time hourly rate for hours worked up to 40, and then time and a half for the hours worked in excess of 40. That time and a half is the regular rate of pay. There is actually a final rule that the department is supposed to finalize according to today's regulatory agenda in November. So in the next week, I would say let's call it a month, we're going to know a little bit more about the department's position on various types of payments that go into the regular rate of pay. But for our purposes, just understand that the regular rate of pay includes things other than the straight hourly rate. So commissions can go into the regular rate of pay, and certain non-discretionary bonuses can go into the regular rate of pay. The different differentials go into the regular rate of pay, and all of those things increase the overtime rate. So when you're paying someone hourly, you need to pay attention not only to the straight time rate, but also to the overtime rate that you're going to end up paying. There is a method of pay that is salary plus overtime. So you can say, we're going to pay you a salary of whatever that amount is. So let's call it $500, and that's going to be your salary for all hours worked up to 40 in a work week. And so we'll take 500 and we'll divide that by 40. That gives us $12.50 an hour. And so we'll multiply that by 1.5. That gives us $18.75. So in this circumstance, you would say, look, we're going to pay you $500. That $500 is going to cover you through 40 hours. And then for hours worked over 40, we're going to pay you $18.75 an hour for all of the hours worked over 40. That just gives the employee a little bit more security in their sub 40-hour work weeks, right? They're still being paid some salary, but they're getting extra for working extra. Obviously that's a much larger cost for you. And it's important to note that the regular rate of pay will continue to include all of those other payments that I referenced earlier. This does not get you out of computing the regular rate of pay. It just says that their base overtime rate is going to be based on that salary number. Fluctuating work week, and there's actually, the Department of Labor is incredibly busy in the wage and hour world, and there's actually a proposed rule on fluctuating work week at the Department of Labor right now. And it would actually improve the ability of employers to use the fluctuating work week. The thing about fluctuating work week that is important to remember is that it is a federal provision. It does not work in California. I think Pennsylvania is always a state where we caution using fluctuating work week. On all of these issues, you need to also look at state law. What we're talking about here is just a federal standard. But under the federal standard, you can apply fluctuating work week. And fluctuating work week allows you to take that salary. So again, if we talked about a $500 a week salary, rather than dividing the salary by 40, we would divide that salary by all of the hours worked in the work week. So whereas when we divided 500 by 40, we got 12.5. Let's say that the person works 50, we would divide that salary by 50 hours. That would give us $10 an hour, and we would only owe the half-time amount for the overtime hours. So we would pay an extra $5 an hour for the 10 overtime hours, or just an extra $50 an hour. Whereas under the salary plus overtime method, those same 10 hours would be $187.50. So the difference obviously is large when multiplied out over the number of employees who might be reclassified, when multiplied out over each work week where there might be overtime. And fluctuating work week is a way to save a ton of change on that overtime cost, particularly for an employee who is transitioning from exempt to non-exempt. The flip side of fluctuating work week, the benefit to the employee, is that they're guaranteed that salary for all of their weeks. They're guaranteed to get that salary in the weeks where they work 34 hours. That is the trade-off for the employee in the reduced overtime rate, is that they get the increased salary protection. That final bullet point is really just fluctuating work week with less math. So instead of dividing it by all hours worked, you have the same agreement with the employee that the salary is going to cover all hours worked, but you base the halftime rate on the 40-hour divisor. So you would, again, divide 500 by 40. That gives you 12.5. 12.5 divided by 2 is 625. So in that situation, you would pay $625 for each overtime hour. It is going to result in an overpayment every time as compared to fluctuating work week, but it gets you out of having to do that calculation week after week after week. How do you determine what amount you should even pay? Obviously, this is less legal and more HR, more employee relations. This is, how are we going to keep our workforce happy? How are we going to keep our associates happy? Some employers will just say, hey, we're going to pay you the same salary. So if you were being paid a salary of $600 a week. We're going to continue to pay you $600 a week. We're going to go ahead and pay you $600 plus all of the overtime hours. However you decide, whether you use straight hourly or salaried at 40 or fluctuating work week, all of those have increased costs on overtime hours. So if the person's salary remains the same, your ultimate labor costs are going to go up because you are paying for the overtime hours. The other alternative is you can say, look, we are going to assume that you are going to work 50 hours a week. And if you do work 50 hours a week, your salary, which is going to be slightly reduced as a salary, plus the overtime that you work for those extra 10 hours is going to get you to the same level that you were earning before. Again, this is it's more of an employee morale issue than anything else. If you actually choose the path where you are reducing someone's pay to account for the overtime costs, there are a number of states where you will need to issue wage change notices and things like that, because it is actually a reduction in someone's base pay. But in either case, regardless of what we're doing on determining how we're going to pay, what rate to pay, you need to make sure you communicate it well. You need to get out as early as you can on that, and consider your employee relations with that. It is really a communications issue and an evaluation of employee morale issue more than there's anything legal. There's the legal magic around it. It's not really a legal issue. It really is a communications issue. What we see happen when someone gets reclassified from exempt to non-exempt, and admittedly a lot of times this is after a lawsuit where an employer has lost and has learned that their exempt employee has to become non-exempt. There's sort of a slippage in how we treat reclassified non-exempt employees as compared to long-term, long-time non-exempt employees. So whereas we all know how to handle our wait staff and our housekeeping staff and our grounds folks, on an hourly basis, when you reclassify a manager from exempt to non-exempt status for whatever reason, employers don't maintain the same level of vigilance in paying attention to similar issues. That is a big no-no. You need to focus on the same issues. You got to pay attention to off-the-clock work. You got to pay attention to making sure that everybody gets their meal and rest breaks. You got to talk about travel time issues. A lot of times we have remote access issues when a manager is reclassified, is used to maybe sending emails from home, from a mobile device. Those are all things that we need to consider with a reclassified employee who are paying by the hour, because now that's an hour worked, whereas in the past, it was just part of their salary. It was part of what they did in a week. Now that's extra time that we need to make sure we're paying for. I think we talked briefly earlier about just restructuring. Obviously, you can use this as an opportunity to shed non-exempt duties off to clearly non-exempt employees. You can use it to make exempt positions, what I say is more exempt, right? You can combine two positions and say, we're going to take some of those non-exempt duties, we're going to give them to an hourly worker, and we're going to make this new position more clearly exempt with less non-exempt responsibility. This is, again, a good opportunity to take care of those types of issues. Wrap up here because I want to leave some time for questions. I think once you identify what your plan is, are we going to increase pay? Are we going to change people's methods of pay and reclassify folks to non-exempt? It is critically important to make sure that you have a communications plan, that you are going to bring in key managers, key representatives at the property to communicate to the impacted employees in a way that lets them know that this is not a reflection on their value to the business. This is not a reflection on how we think they are performing, that this is just a decision that's based on the legal realities or a regulatory change or something like that. Come up with that communications plan, roll it out, make sure the right people are involved, because the worst thing that can happen out of this is you get a lawsuit where somebody says that they have been improperly classified for all of this time, and this is just your cover for getting out of that improper classification. You don't want to draw a lawsuit because you failed to think through your communication strategy in rolling out this new compensation plan that you've had to develop as a result of this regulatory issue. With that, I think I will hang on here. I'm going to leave that page up because there we go. We're at Q&A. I'll go through the Q&A. And there is a question that says, would I be correct that this does not apply to sales outside or inside managers who are exempt? So here's the deal. Outside sales, right? So someone who is regularly and customarily engaged away from the property for the purposes of getting orders, for making sales, that person, that position is an outside sales position, and outside sales are not subject to the salary test. So there is no salary test for outside sales. Inside sales is a trickier issue, and if it is someone who is actually has a primary duty of sales, but they are inside, there are cases out there that say that that person is not exempt to begin with. But let's, for our purposes, assume that we're talking about a sales manager, an inside sales manager who is able to meet the duties test because they have different responsibilities than just sales. If that person meets the duties test, then they would need to be paid the increased salary in order to maintain exempt status. So they would be subject to the same salary rules. So outside sales, not subject to the salary rules. All the other white-collar exemptions, with the exception of doctors, lawyers, and teachers, need to be paid the full salary. But again, you have to make sure that the individual meets the duties tests in order to meet the exemption. It's not just a salary piece. There's a question about how many hours are required for an exempt employee. There are no hours requirements for exempt employees. Exempt employees can work anywhere from 1 hour a week to 168. And 168 is the max only because that's 7 times 24. Anything in between is permissible for exempt employees. So there's no minimum, no maximum on what an exempt employee can work. There is a question about the duties of an exempt employee. So I can quickly run through the duties tests. The first is the executive exemption. The executive exemption is the managers, right? It is a manager position. It is someone who supervises 2 or more full-time employees, who manages a recognized department or subdivision, right? So it's got to be somebody who's managing an department, who supervises 2 or more, and who either has the ability to hire and fire, or whose recommendations with respect to hiring and firing are given significant weight. So there's an understanding that in many cases, nobody actually has the ultimate authority to hire and fire. It's got to go through a million different people in a million different parts of the organization in order to bring somebody on or let somebody go. But if you are a manager who says, look, this person should be fired, and that's sort of the driver on why someone should get fired, that is enough to satisfy the executive exemption. There is an exemption called the professional exemption. The professional exemption is for people who have fancy degrees, right? So it is, I would say, master's degrees or higher. The job position requires a master's degree or higher. There are circumstances where a bachelor's degree will suffice. I jokingly say that it's in those circumstances where it's a degree that somebody doesn't use to go to law school, right? So one of the hard science degrees is likely enough as a bachelor's degree to satisfy it. I don't know when that would come up in the hotel context, but there are certain circumstances where you could get there. Creative professionals, so sometimes when you're talking about graphic designers, things like that, they can meet the creative professional exemption, and that will get them to be exempt. And then the third big bucket of exempt employees is the administrative exemption. The administrative exemption is for people who perform office or non-manual work directly related to the employer or the employer's customers' general business operations, and who regularly and customarily exercises discretion and independent judgment with respect to matters of significance. Not surprisingly, that is where most of the litigation is, because all of that is a lot of gray area wording, but it is people who are involved primarily in what we would say is back office functions related to running the business, not the business that we're in, but sort of the accounting, marketing, those types of roles, and who are making decisions, important decisions on their work on a day-to-day basis. And those are really the three big buckets of exempt classifications. Duties tests. There's a question about right to work and whether the exempt employee duties apply. Yeah, they apply. It's a federal provision. You would need to meet the exempt duties provisions. Right to work has to do with union issues and whether there can be closed union shops and things like that. So in our circumstances, you would look at these federal provisions, and you do have to look at the state ones as well, but right to work is not something that impacts this analysis. This analysis is, the exempt duties, the exempt salary, do they meet them? So we look at that first at a federal level, and then particularly in places like California, Illinois, New York, we need to look at their salary levels as well and ensure that we're paying more than those salary levels. I think those are the questions that were in the Q&A queue. Chris, is there any other questions?
First, a reminder for everybody that this webinar is going to be available on AHLA's website as a recorded option for those that want to go back and listen. Alex, one question that we had here that we discussed with some members is the January 1st effective date. Obviously, that's going to be in between a pay period. Can you walk through kind of how people deal with that aspect of it, where January 1st is a Wednesday?
Yeah, I mean, I think the best course of action is just to say that the work week that includes January 1st, you're just going to pay at the higher rate. I think that there is an argument that you could, prorate the salary over the work week to say we're going to pay the lower salary in the first half of the work week and then increase it in the second half of the work week to ensure that we meet the January 1 level. Number one, I think that is just begging for someone to make a mistake. And then number two, there's not actually case law on that issue, and you wouldn't want to do that for a whole bunch of employees and then find out you were wrong, because then you're gonna have to deal with that in litigation or an investigation. So particularly because you're really only probably talking about an increase of a couple of hundred. I mean, the maximum increase that we're talking about to comply is like $230, and $230, and you'd only be increasing it with respect to 40% of a work week. You're looking at $75, $80 max, and it's probably just worth saying any work week that includes January 1st, 2020 should be paid at the higher rate.
Got it. Is there anything you can do to wrap up in terms of your final piece of advice for folks on the phone in terms of what they need to do to be compliant come the end of the year?
Yeah, I mean, I think, the time was probably actually, a couple of weeks ago where you should really be digging in. But if you haven't turned to it, you need to turn to it now. And what I would do is focus on those positions that are currently exempt and that earn between $23,660 and $35,538. And that's where all of your attention should be. And you need to decide, are we going to raise or are we going to convert? Because those are really the two main options that you have. And you need to sit down and do that now, because there's no grace period. If someone is earning under $684 a week on January 2nd, that person is non-exempt and you owe them overtime. Hard stop. So take a look at that gap between $23,000 and $35,000. Review those positions that are currently classified as exempt, and make your decisions, and then go forward.
Excellent. Well, Alex, thank you again very much for your time and insights into this issue and your continued partnership with AHLA. Another reminder for folks that this webinar is going to be available as a recorded option on our website. If you have additional questions, my email is cburgoyne, BURGOYNE, @AHLA.com. Alex's contact information is also on the screen if there's anything that your company is looking to explore further, and Alex's services would be separately there. But obviously, Alex is a true professional on this, has been a great partner with AHLA, very well-versed in the issue, and we hope that you all found this to be informational and helpful to your businesses, and we appreciate your support of our efforts here at AHLA. But thanks again, Alex, and everyone have a wonderful Thanksgiving and holiday season.
Thanks, Chris.
Thanks, everybody.